Markets looking to end the week on a high note this morning after yesterday's sell-off. It has now been a wild week for investors. Joining us right now to talk through it, Altium Wealth Portfolio Manager and Market Strategist Michael Lee. Michael, good to see you.
Morning. How are we doing?
So assess the damage for us. Look back, look ahead. How do you see markets?
Look, as interest rates go up, we're going to see increased volatility. Okay, I think this is all interest rate related. The notion that the market would sell off 1 or 2% based on a journalist being either murdered or not murdered is a little bit insane. Whether Secretary Mnuchin goes to a conference, doesn't go to a conference, should not affect the day-to-day trading in the market. So I believe this has everything to do with interest rates, and more so the expectation that interest rates were never going to go higher again. And I would make the argument that the movement off ultra lows is extremely beneficial to the United States. It says that our economy is growing and that we're not on the track of Japan.
Yeah, we certainly have strengthening economic conditions, but the market is sort of ignoring that because they're worried about next year, right? The comparables are going to be harder. You've got possibly operating margins coming down because of what's happening, rising input costs of financing from yields going up, as well as the cost of labor, cost of goods with trade wars. But my concern is not in that. My concern is that people are fundamentally misunderstanding the strengthening economic story. It may not be as bad as they're anticipating next year because buybacks are going to be happening. There's going to increase dividends. So where do you think the market goes from here into next year? Are we going to see a few percent next year? Are we going to see 10% next year? What's your economic forecast for the economy and then also the market? So
you take a look out now, right? You get three options: stocks, bonds, and cash. So if you're going to buy some cash, you keep your money in cash, you're going to make maybe 2-3%, something along those lines. Okay, if you're going to buy bonds, chances are you're either going to be flat or lose money because interest rates are going up. And then you look at the stock market, where we have an improving economy. We have relatively cheap multiples, 15, 16 times forward earnings, double-digit earnings growth as far as the eye can see, single-digit revenue growth, and an economy that's growing faster than it has in 20 years.
So why is J.P. Morgan saying a recession's on the horizon?
Yeah, because I think the business cycle, the fact that we are in the longest business cycle, and this is going to be the longest expansion we've ever had, people tend to believe that it's an easy bake oven, or this is a batch of brownies, and after a certain period of time, we need to have a recession. Right. There is zero data on the horizon that could remotely predict a recession. So if we're going to have one, it's from data or things that haven't happened yet.
But you know what it is? It's because it's easy to be negative.
Yeah, exactly.
You don't take any risk saying there's going to be a recession 2 or 3 years from now. It takes a lot of guts to say, hey, we are more than 9 years into a bull market, about 9.5 years, and we don't see anything that's going to get in the way of that. That takes real guts.
You're so right.
And particularly in the markets selling off. Right?
Just one thing, because people were so worried about inflation. If you look at the Unilever numbers from yesterday and also Nestle, they're raising prices because of inflation. That's why in an inflationary environment, modest inflation, you want to own stocks. Here, you don't want to own fixed income. And we've got Procter & Gamble coming out later this morning. But so far, 15% of the S&P 500 has reported, and earnings per share have come in almost 27% above year-ago levels.
You're absolutely right.
It isn't having the big push that it's had in the past, though. The last several earnings cycles, when that kind of above expectation numbers came in, the stocks popped. Now it's sort of like that's almost baked in, you know? I mean, I think that is, I totally agree with you. I think this whole increase in volatility is because every time the rates start to go up, everybody takes a pause and says, well, can we still grow through this? And the answer is so far, yes, we can.
Yeah, look, if you look at similar economic data that we're having now, you had it in the 90s, and rates were much, much higher. I think we're in a very similar period to 1994, 1995, where kind of ugly years in equity markets, a lot of volatility, but however, we took off after that. I think the next, the best is absolutely yet to come.
All right. We will leave it there. Michael, great to see you.
Okay, thanks so
much. Michael Lee joining us there.